Today is February 27th, 2026. March 1st Notice Day. The deadline when silver futures contracts become physical delivery obligations. Right now, over 10,000 contracts are standing for delivery. That's 52 million ounces of silver that buyers have declared they want physically delivered. Against that demand, COMEX holds just 86 million ounces in registered vaults. That's 61% of the entire deliverable stockpile claimed on day one. This number should never exist, but it does. And while this crisis unfolds, Pakistan just declared open war on Afghanistan. The Middle East is 48 hours from potential military action. And 2 days ago, the CME halted silver trading for 90 minutes and crushed the price by $6. This isn't just a silver squeeze anymore. This is financial warfare meeting actual warfare. Hi, I'm Roxanne. Before we dive in, let me be crystal clear. I sell nothing. No courses, no memberships, no premium signals. Just raw data you can verify yourself from COMEX reports, CFTC filings, and official exchange data. Over the next 25 minutes, we're going to walk through exactly what happened 2 days ago, what's happening right now on First Notice Day, why registered inventory at 86 million ounces is catastrophically low, how Pakistan-Afghanistan war and Iran tensions are driving safe haven flows, and what the May and July delivery cycles look like when there's no metal left to deliver. Let's start with what happened 2 days ago, February 25th, 12:11 p.m. Central Time. The CME Group acknowledges technical issues affecting metals and natural gas trading. By 12:15 p.m., a full trading halt is confirmed. Silver had been trading above $91 per ounce and breaking out toward $92 resistance. Momentum was building. Volume was healthy. Then everything stopped. Natural gas resumed at 12:50 p.m., a 35-minute halt. Metals stayed dark until 1:45 p.m. That's 90 to 100 minutes frozen. When trading resumed, silver didn't bounce. It collapsed. From $91 to $88 initially, then $86, then $85 across 3 consecutive selling waves. A $6 total move in hours. Coordinated selling pressure that detonated the instant trading resumed. And here's the part that reveals the real purpose. March open interest collapsed by 11,356 contracts in a single day. That's over 56 million ounces of delivery pressure that vanished overnight. More than 50% of the delivery demand, gone. The official CME explanation? Technical issues. 2 words, no elaboration. This was not the first time. November 27th through 28th, 2025. The CME executed a 10-hour trading halt. The official reason? Cooling system failure. That halt also occurred on First Notice Day for December silver. Reports described a Chinese industrialist who had notified COMEX of intent to take delivery of 30 million ounces. Silver was at $53 when the halt began. After trading resumed, silver rallied from $53 to $121, a 128% move over 60 days. But then, the CME hiked silver margin requirements by 50% over 2 weeks. Forced liquidations crashed silver from $121 back to $63, a 48% collapse. The pattern is consistent. Halt, deflate, margin hike, crush, recover, repeat. Which brings us to today, February 27th, 2026, March 1st Notice Day. 10,526 contracts are standing for delivery. That's 52.63 million ounces that buyers want physically delivered. Against that demand, COMEX registered vaults hold 86.13 million ounces. Do the math. 52.6 million against 86 million. That's 61% of the entire deliverable stockpile claimed on a single First Notice Day. Delivery months are supposed to be managed events where only 2 to 5% of contracts ever request physical metal. What's happening right now is that the physical market and the paper market are in open conflict. In October 2025, registered silver stood at 168 million ounces. By January 2026, it had fallen to between 113 and 127 million ounces. On February 11th, registered silver broke below 100 million ounces for the first time in recorded COMEX history. 100 million ounces was an untouchable floor that held through every prior crisis for decades. As of today, registered silver sits at 86 million ounces. That's down 49% in just 4 months. The drainage rate in early February was running at 785,000 ounces per day. This metal is not reclassifying into eligible. It's leaving the COMEX system entirely. Buyers took delivery and removed their metal. Full stop. January and February 2026 combined delivered 74.38 million ounces through COMEX. That's 86% of today's entire registered stockpile consumed in 60 days. Full year 2025, COMEX delivered 474 million ounces, more than double 2024's 203 million ounces. The delivery percentage has been running near 98%. In a normal market, delivery rates run 2% to 5%. 98% means buyers don't trust paper settlement. They want the metal. They're taking possession. The assumption that most contracts will settle in cash or roll forward has broken down. Silver lease rates in London spiked to 35% annualized, with intraday peaks reaching 39%. Normal silver lease rates run between 0.3% and 0.5%. That's a 70 to 80 times multiple over normal. When rates spike that dramatically, people who hold physical silver are refusing to lend it. They expect prices to be significantly higher soon, or they're concerned about counterparty risk. The exchange for physical spread expanded from 25 cents per ounce to over $1.10. This is the arbitrage channel that normally keeps prices aligned between markets. When it expands that dramatically, physical metal is being demanded urgently in New York, and the pipeline from London is constrained. The estimate circulating among analysts is that freely circulating London inventory may be as low as 4,000 tons, approximately 129 million ounces. When daily clearing volumes are 200 million ounces, you're operating a system where paper claims dramatically exceed available physical supply. Mexico is the world's largest silver-producing nation, accounting for 23% of global mine supply, approximately 6,300 metric tons per year. On February 22, 2026, U.S. forces working with Mexican military killed CJNG leader El Mencho in Jalisco. Within 48 hours, retaliatory cartel violence erupted across 20 Mexican states. Highways blocked, convoys attacked. In January, 10 employees of Vizsla Silver were abducted from their Panuco Silver project. 5 were confirmed dead. The company's stock dropped 50%. Reports suggest that transportation of refined silver from Mexican mines to export facilities has been effectively halted for several days, with no clear timeline for resumption. The miners haven't stopped production, but refined silver that cannot be transported cannot reach vaults. The gap between what's being mined and what's reaching COMEX is widening. Since January 1, 2026, Chinese authorities require special government licensing for silver exports. China controls 60 to 70% of global refined silver refining capacity. These export restrictions have reduced Chinese refined silver export volumes by approximately 40% since the policy took effect. Meanwhile, the Shanghai Futures Exchange restricted 23 accounts in February for exceeding position limits. These are not normal market operations. These are the actions of an exchange managing physical supply tightness through administrative controls. This morning, Pakistan declared open war on Afghanistan. Defense Minister Khawaja Asif confirmed Pakistani air forces struck Kabul, Kandahar, and Paktika province after Taliban forces launched large-scale attacks overnight. Pakistan claims 274 Taliban fighters killed. The United Nations issued a statement of deep concern. An active declared war between nuclear-armed neighbors in Central Asia is precisely the kind of risk event that drives institutional flows into hard assets. Gold is already at $5,178. Silver, at $90 in this environment, is arguably still cheap. United States-Iran nuclear talks wrapped in Geneva on February 26th without a deal. Technical talks are scheduled to resume in Vienna next week. However, the U.S. has deployed 2 carrier battle groups to the Persian Gulf region, and CENTCOM has briefed the White House on military options. A breakdown leading to military action would affect Saudi oil facilities, Persian Gulf shipping, and global energy prices in ways that would strongly support precious metals. COMEX open interest in silver is declining. Money is leaving the futures market. At the same time, SLV saw net inflows of $849.6 million over 5 days through February 27th. 3-month inflows, $1.58 billion. 1-year inflows, $3.61 billion. SLV short interest hit a record 73.55 million shares in early February, 12.8% of outstanding shares. The subsequent 38% collapse in short interest to 45.79 million shares tells you those shorts were being covered rapidly. On February 25th, the day of the CME halt, SLV options volume hit 61 million shares in notional exposure, approximately $4.9 billion in a single session. Implied volatility ran at 99% to 103% annualized versus 37% historical realized. The options market is pricing silver like it could move 50% in either direction in the next 60 to 90 days. That's a market preparing for a discontinuous event. The CFTC Commitments of Traders report shows managed money's net long position has collapsed 77.7% year over year, falling from 54,415 contracts in February 2025 to just 12,121 today. Hedge fund long positions are down 78% year over year, while silver rallied from $30 to $121. The price move was driven by physical delivery demand, by industrialists, sovereign wealth funds, and institutions taking metal out of the exchange system and not bringing it back. The CME's compression of March open interest from over 85,000 contracts to 10,526 didn't solve the problem. It postponed it. COMEX registered inventory is at 86 million ounces and draining at 785,000 ounces per day before March deliveries begin. If delivery rates continue at 98%, March could demand another 40 to 50 million ounces. The vault would exit March between 35 and 50 million ounces, the lowest in modern history. May 1st notice day is 63 days away. That restocking requires silver to flow from Mexico, and that's under cartel siege, London, which is already shipping metal west for months, or China, who restricted exports by 40%. There is no obvious large-scale source of replenishment. In March 1980, COMEX declared liquidation-only mode for the Hunt Brothers Silver Corner. Silver crashed from $49 to $10.80. The exchange intervened to protect shorts. In 2011, the CME executed 5 consecutive margin hikes in 9 days when silver approached $50. Silver crashed 30% and never recovered to $50 in the subsequent decade. The February 25th halt follows this playbook. The difference this time is the physical vault inventory. In 1980 and 2011, COMEX registered silver was plentiful. Today, the vaults are at record lows. The exchange can manage open interest through halts and margin hikes. It cannot conjure physical silver that doesn't exist. Solar photovoltaic manufacturing now accounts for 20% of annual silver demand, up from 4% in 2015. Each gigawatt of solar capacity requires 50 tons of silver. Global solar installations are projected at 700 gigawatts in 2026. AI data centers require silver-intensive connectors, circuit boards, and cooling systems. EV transition requires silver in charging infrastructure and battery management systems. None of these demand drivers are discretionary or price-sensitive in the short run. Manufacturers don't have silver substitutes at commercial scale. Samsung reportedly secured an exclusive 2-year offtake agreement with a major silver mine this month, bypassing exchanges entirely. When the world's largest electronics manufacturer goes straight to mines with multi-year contracts, they see what's coming. The dollar index is down 9.2% over the past 12 months. The 10-year Treasury yield has fallen to 4%. Real yields have dropped from 1.98% to 1.72%. Every one of those moves is tailwind for silver. The gold-silver ratio has compressed from above 100 in early 2024 to 57.78 today. Historical precedent suggests the ratio can compress toward 35 to 45. At current gold prices of $5,178, that would imply silver prices of $115 to $148 per ounce. JP Morgan's official average for 2026 is $81 per ounce. Citigroup projected $100 by March, with upside to $110 in the second half. Silver trade targets a retest of the January all-time high at $121.78. The Kitco Silver Survey found 57% of retail investors expect silver to trade above $100 at some point in 2026. The critical technical level is $91 to $92 on the upside and $82 to $84 on the downside. A break above $92 opens the path to triple digits. A break below $82 signals more selling pressure, with next support at $75 to $78. Everything I've described is real and documented. The inventory drain is real. The lease rates are real. The Mexican supply disruption is real. The geopolitical stress is real. What's also true is that this market has delivered the most violent price swings in its history, from $71 to $121 to $63 to $90. Anyone who bought at $120 experienced a 48% drawdown in weeks. The structural bull case does not protect you from manufactured volatility designed to shake out weak hands. You need position sizing that survives the swings and a time horizon measured in months and years, not days and weeks. Today is March 1st, notice day. 10,526 contracts standing for delivery, 52.6 million ounces. That's 61% of registered inventory claimed on day one. COMEX registered silver has fallen from 168 million ounces to 86 million ounces in 4 months, a 49% collapse. Delivery rates are running at 98% versus historical norms of 2% to 5%. London lease rates hit 35%. Mexico's silver supply is disrupted by cartel violence. China reduced exports by 40%. Pakistan declared war on Afghanistan. Iran negotiations are 48 hours from potential breakdown. 2 days ago, the CME halted metals trading for 90 minutes and crushed silver by $6, eliminating over 50% of March delivery pressure in a single session. The exchange can manage open interest through halts and margin hikes. It cannot conjure physical silver that doesn't exist. We're 48 hours into March settlement. May 1st notice day is 63 days away. Between now and then, COMEX needs to restock from sources that are actively disrupted or restricted. The question is not whether the physical market ultimately wins. The question is how many times and at what cost the paper market can delay the reckoning. This is financial education, not investment advice. Every claim can be verified through COMEX vault reports, CFTC positioning data, and official exchange publications. If this changes how you see what's unfolding, share it. Drop a comment, hit subscribe. The next 30 days will tell us more than the previous 10 years combined. The data doesn't lie, the vaults are draining, and there's a war involved.